So today we are going to do adjustment of capital in retirement. So this is the sum number 46. In this sum, first we'll read the sum and then I'll explain you. The balance sheet of ABC on 31st March 21 was as follows. Liabilities and assets are provided to us. If you see carefully, there's a tick mark already on line of building, plant and machinery, debtors and creditors. The following terms were agreed upon of A's retirement. Goodwill is to be valued at 42,000 and not to be shown in the books of the firm after A's retirement. That doesn't matter. Generally, we don't show this goodwill in the balance sheet. Land building appreciated, so put a tick mark on land building. Plant and machinery also, there's some reduction, so that's why there's a tick mark on plant. Provision on doubtful debt, so tick mark on debtors. A result on discount on creditors, so tick mark on creditors. And the last adjustment is the important one. This is the adjustment for a adjustment of capital. Okay, so basically in the retirement, they want to change the capital of the partners. In the previous two sums which we have done, in that sum, the capital was provided to us. But in this sum, we need to calculate the capital. For what adjustment they have mentioned in the sum, just read it. A sum payable to A to be brought by B and C in such a manner that their capital are in proportion to their new profit sharing ratio. So basically, they decided to pay retired partner immediately, and for that purpose, B and C has to bring that much money in such a manner that capital are in proportion to their new profit sharing ratio. So this is called as adjustment of capital in retirement. Clear? Can we start? Prepare revaluation account, partners capital account and balance sheet of the new firm effect to the above terms. Right? Can we start? So first here I'll make the balance sheet. This is balance sheet. Here I'll make the revaluation. And partners capital. This is a revaluation account. And this is partners capital account. Partner names are A, B, and C. Correct? Then we will start putting all the assets and liabilities. So first land and building, 80,000. Plant and machinery, 56,000. Motor car, there's no tick mark, so I can put it out directly, 54,000. Debtors, 48,000. cash 2000. There's a changes in the cash, so I'll write this inside. And profit loss account that we are going to distribute, right? Because these are the reserves which we generally distribute, and the list of reserves it's mentioned which reserves we are going to distribute. So P&L account and all these things always we distribute. What's the rule for that? If it is given on the asset side, we'll distribute on the debit side of capital. Okay. And any reserves on the given on the liability side that get distributed on the credit side of capital account. So here it is given on the asset side. So we'll distribute on the debit side of capital account to P&L account. See what is the amount given? 30,000 amount is given to us. This 30,000 we have to split in their old ratio. Check what is the old ratio given in this sum. There's no old ratio, no new ratio, nothing is given. So we'll consider is equal ratio. So old ratio is equal between ABC. So 30,000, if I split it equally, I'll get 10,000 each. Okay, so asset side is completed. Now liability side. So these are the capital balances 80, 80, 60 that I'll record in the capital balances by balance brought down. 80, 80, 80, 60. B also 80 and C is 60. Correct? Then under liability side, we have one more thing which is creditors 50,000. That, sorry, I'll record in the balance sheet liability side. I'm leaving 4-5 lines for capital because it's reserved. Creditors is 50,000. That also inside because it has a tick mark. Correct? Now the following terms were agreed upon for A's retirement. Goodwill is valued at 42,000. Okay, so whenever they're given the goodwill, it's a firm's goodwill, we need to calculate a retired partner's goodwill. So A's goodwill is equal to 42,000 into A's share. The old ratio between all three partners are equal, that's why 1/3. So 42,000 divided by 3 is 14,000. That we are going to split. No new ratio given, so I'm going to split in the old ratio. See, this was the ratio for partners. A retires, what is left? 1:1. So I split this in 1:1. So 7,000 and 7,000. Means B will provide 7,000, C will provide 7,000 to A. Right? The normal goodwill adjustment we used to do. So we credit to A 7,000 and another 7,000. First 7,000 B will give B's capital account, then I'll write here, and then the other 7,000 C will give, so I'll write C's capital account. Okay, so we credit it to A because A is leaving the business, and then I'll debit to B and C 7,000 and 7,000. So here I'll write to A's capital because both of them are giving it to A. So I increase the capital of A because he's leaving, and I debit it to B and C. It means I decrease the capital by 7,000. Correct? After that, land and building to be appreciated by 20,000. So appreciated means add 20,000 comes to 1 lakh. Now land and building means asset appreciation. It's a good thing for us. That's why reval credit side. Land and building 20,000 on the credit side. After that, we have a plant and machinery to be reduced to 46,000. They say 2. 2 means what? It becomes 46,000 now. It was 56, it becomes 46. It means it is depreciated by 10,000. And asset depreciated is a bad thing for us. That's why I'm writing on the debit side of reval, plant and machinery 10,000. Correct? Next, provision for doubtful debts to be created 5% on debtors. Say 5%. So I'll charge 5% on debtors. 48,000 into 5%. 2,400. If I subtract that, I'll get 45,600. There's no old provision, so this full 2,400 is the new provision which we made, and it is asset reduce, so it's a bad thing. So that I'll record on the reval account debit side to provision. Okay. After that, a reserve for discount on creditors to be made 1,400. So that I'll subtract from creditors 1,400. So 50,000 minus 1,400 is 48,600. Creditors reduce is a good thing or bad thing? It's definitely good thing, because liability reduce is always good for a business. 14. The sum payable to A brought by B and C means this is an adjustment of capital in retirement. How to do this? For that, there are some terms and conditions already given it to you in the rule section, in the notes section. Do you remember that there are 4 steps? Step 1, step 2, step 3, and step 4. Okay, I'll just bring down that steps over here. For the adjustment of capital, this is the rule, or you can see notes. See, I mentioned over there reshuffle of capital means adjustment of capital. There are 4 steps: adjusted balance of continuing partners, then plus amount due to retired partner, plus required cash, and less existing cash. Okay, for that we have some conditions as well. What are the conditions? See, step 1 is compulsory for adjustment of capital. Every adjustment of capital, step 1 is compulsory. For that, there is no condition. For step 2, what is the condition? See, the condition for step 2, if they decided to pay retired partner immediately, but not arranging from other source like raising a bank overdraft or bank loan. So check in the sum. See, if you see in the sum, amount, the sum payable to A brought by B and C, it means they decided to pay immediately, right? It means they decided to pay immediately to A. Because here they mentioned the sum payable to A brought by B and C. It means they decided to pay immediately. So that condition match. Since condition match, they decided to pay retired partner immediately. Second is what? But not arranging from any other source like bank overdraft and bank loan. So in the sum, anything is mentioned. For that, they are arranging a money from a raising a overdraft or raising a loan somewhere. No, right? The second condition also match. So we are going to use the step 2 as well, right? Because step 2's conditions are matching. Check. For step 3 and 4, both will come together when they decided to keep certain balance in cash or bank. Is there anything mentioned in the sum that they want to keep 10,000 or 20,000 in the bank balance or something? Check in the sum. See, it's not mentioned anything about that. They want to keep some balance in the bank, certain balance, not mentioned. So this condition is not matched. Correct? This condition is not matched. So we are not going to consider step 3 and step 4. Is it clear? Only step 1 and step 2, step 3 and step 4 we are not considering, because the condition for step 3 and step 4 is not fulfilled. Okay, so what about step 1 and step 2? Adjusted balance. How will I get the adjusted balance? When I close the capital account. And the second result, amount due to retired partner, that also I'll get after closing the capital account. So first I'll close the accounts. First I'll close the reval. I'll distribute the profit and loss among partners. Credit side is a heavier, 21,400 minus the debit ones. 21,400 minus 10,000 and minus 2400. It's coming 9,000. This is the profit for revaluation account. So this profit we always distribute among partners in their old ratio, which is 1:1:1. So if I split this 9,000 in equal proportion, I'll get 3,000 each. That 3,000 I'll record over here by a revaluation account. 3,000 each. Then I close the partners capital account to get these balances, what we need for reshuffle capital, or you can say adjustment of capital. Okay. So 80,000 plus 7,000 plus 7,000 plus 3,000 is 97,000 for A. 97,000 minus 10,000 is 87,000. What is this 87,000 means? That's all we supposed to pay to A when he leaves the business, because that is his adjusted capital balance. After doing all adjustment, his capital balance, residual balance of his capital is 87,000 that we supposed to pay him, right, in a retirement. Similarly, I'll close for B and I'll try to get his capital balance, adjusted capital balance after doing all adjustments. So 83,000 is the total of the credit side, and from that I'll separate the total of the debit side, which is 10 plus 7 is 17. Then I'll get 66,000 for B. Similarly, I'll close for C also. The total of the credit side is 63,000. This 63,000 I'll put it over here, and from this also I'll subtract the 17,000, whatever I have on the debit side. Okay, so these are the balances, adjusted balances after doing all the adjustments given in the sum. These are the balances we got it of all three partners: 87, 66, and 46,000. Correct? Now, step 1. What is step 1? I'll just show you once. Step 1 is what? Adjusted balance of continuing partners. Continuing partners. So we'll take the adjusted balance of continuing partner. Who are continuing? B is continuing and C is continuing. So what are the adjusted balances we got? 66,000 for B and 46,000 for C. So step 1 is what? 66,000 plus 46,000, which is 1,12,000. This is step 1. Plus step 2, as we already discussed, we are going to consider 2 steps in this sum. So step 2, what is step 2? I'll show you. Amount due to retired partner. Amount due to retired partner. So what is the amount due to retired partner? 87,000 that we just calculated. So plus 87,000. So 1,12,000 plus 87,000 is 1,99,000. This is the new capital of the firm. Previous sums made, they have already provided this balance. This sum they ask us to calculate, and for that we need these steps. We need these 4 steps. So these 4 steps, and for that also we need to have some conditions, and I check the conditions. So first condition is fulfilled, but second condition is not fulfilled. That's why I'm not using step 3 and step 4. I'm just using step 1 and step 2. Correct? Okay. So 199 is the new capital balance that I'm going to split between B and C. The new ratio also not provided, so I'm considering equal. 199 divided by 2 is 99,500 for B and 99,500 for C. Okay. Now we need to compare the new capital and existing capital. B's new capital is 99,500 and his existing capital is 66,000. So definitely there's a deficit, because new capital means as per the new terms and conditions, the capital is supposed to be 99,500 for B, but his existing capital is just 66,000. So how do we calculate the deficit? 99,500 minus 66,000. 33,500. What is the deficit? 33,500. How would I got that? 99,500 minus 66,000. So that is the deficit. So when it is deficit, he brings in cash because it will increase his capital. Deficit he brings in cash. 33,500. To make it 99,500, he brings 33,500. It means it will increase his capital. That's why credited to buy cash. Okay. Similarly, for C also we need to calculate 99,500 is the new capital as per the new terms and condition. His existing capital is 46,000. So 99,500 minus 46,000 is 53,500 is the deficit for this guy. He'll also brings in cash. Okay, so these two balances they brought in cash. 33,500 brought by B and 53,500 bought by C. And when they bought in cash, it's but obvious your cash balance will increase by this amount. So I'll adding to the cash 33,500 and plus 53,500. Correct? Now we'll close the capital account finally. Final closing of the capital account. Whenever there's a adjustment of a capital, we need to close the capital account twice. Okay, so this is 87,000. I'll add this 87,000 this side also. And nothing to subtract on the debit side. And what they have mentioned, they are paying to A immediately. That's why I'm writing here to cash because we paid him immediately. And since we paid in cash, I'll subtract from the cash balance. Yeah, 87,000. Now, if I calculate my cash balance, see, first it was 2,000, then 33,500 get added, 53,500 also added, and then we made the payment of 87,000. So final balance I got for the cash is 2,000. Okay. Now I'll close for the other partners. This is 99,500. 99,500. Nothing to subtract. 99,500. This also 99,500. Here also nothing to subtract, so 99,500. For this, I'll write final carried on balance. It means this is their new capital that we already calculated over here. So eventually we'll get the balances. Correct? 99,500 for B and C. That I'll write over here. Capital of B and C. 99,500. Okay. And eventually the balance sheet should match. 99,500 plus 99,500 plus 48,600, 2,47,600. I'll check the other side also. 1 lakh plus 46,000 plus 54,000 plus 45,600 plus 2,000. Correct? 2,47,600. So this is what adjustment of capital.